So GAP distinguishes research and development as follows. Research is planned search or critical investigation aimed at discovery of new knowledge with the hope that such knowledge will be useful in developing a new product or service, or a new process or technique, or in bringing about significant improvement to an existing product or process. Whereas development is the translation of research findings or other knowledge into a plan or design for a new product or process, or for a significant improvement to an existing product or process, whether intended for sale or use. Now, R&D costs include salaries, wages, and other labor costs of personnel engaged in research and development activities, the cost of materials consumed, equipment, facilities, and intangibles used in R&D projects, the cost of services performed by others in connection with research and development activities, and a reasonable allocation of indirect costs related to those activities. General and administrative costs should not be included unless they are clearly related to the R&D activity. If an asset is purchased specifically for a single R&D project, its cost is considered R&D and expensed immediately, even though the asset's useful life extends beyond the current year. However, the cost of an asset that has an alternative future use beyond the current R&D project is not a current research and development expense. Instead, the depreciation or amortization of these alternative use assets is included in research and development expenses in the current and future periods the assets are used for R&D activities. In general, R&D costs pertain to activities that occur prior to the start of commercial production. Commercial production most often refers to the point in time when the company has no other plans to materially change the product prior to beginning production for intended sales to customers. Any costs incurred after the start of commercial production are not classified as R&D costs. These costs should be either expensed or treated as manufacturing overhead and included in the cost of inventory. This slide captures the concept with a timeline beginning with the start of an R&D project and ending with the ultimate sale of a developed product or the use of a developed process. This slide also provides examples of activities typically included in R&D and examples of activities typically excluded from R&D. A journal entry is made to record the research and development expenses here of $4,200,000, which is the of $14,200,000, which is the $10 million plus the $3 million plus the $1,200,000. As you see here, Askew Company made the following cash expenditures during 2018 related to the development of a new industrial plastic. The wages and salaries, $10 million. The R&D consumed during 2018, $3 million. Purchase of R&D equipment, $5 million. Patent filing and legal cost of $100 million, and then payments to others for services performed in connection with the research and development activities. So if the project resulted in a new product to be manufactured in 2019 and a patent was filed with the Patent Office, so the equipment purchased will be employed in other projects. Depreciation on the equipment was $500,000. A journal entry is made to record the purchase of the equipment. The 2018 depreciation is expensed to research and development. A journal entry is made to record the capitalization of the patent filing and legal cost. Even though the cost to develop the patented product are expensed, the filing and legal costs for the patent are capitalized and amortized in future periods, just as similar costs are capitalized for purchased intangibles. GAAP requires that total R&D expense incurred must be disclosed either as a line item in the income statement or in a disclosure note. On the slide, total R&D expense disclosed in 2018 would be $14,700,000. The $14,200,000 in expenditures and $500,000 in depreciation. If Askew later sells this patent to another company, let's just say for $15 million, then the buyer would capitalize the entire purchase price rather than only the filing and legal costs. Once again, the reason for the apparent inconsistency in accounting treatment of internally generated intangibles and externally purchased intangibles is the difficulty in associating costs and benefits. So let's take a look at problem 10.5. Consider each of the following transactions. All of the expenditures were made in cash. The Edison Company spent $12,000 during the year for experimental purposes in connection with the development of a new product. In April, Marshall lost a patent infringement suit and paid the plaintiff $7,500. In March, the Cleanway laundromat bought equipment. Cleanway paid $6,000 down and signed a non-interest-bearing note requiring the payment of $18,000 in 9 months. The cash price for this equipment was $23,000. Number 4, on June 1st, the Jamson Corporation installed a sprinkler system throughout the building at a cost of $28,000. 5, the Mayer Company plaintiff paid $12,000 in legal fees in November in connection with a successful infringement suit on its patent. And then number 6, the Johnson Company traded its old machine with an original cost of $7,400 and a book value of $3,000 plus cash of $8,000 for a new one that had a fair value of $10,000. The exchange has commercial substance. Our job to prepare journal entries to record these transactions. So for number 1, the Edison Company spending $12,000 during the year for experimental purposes in connection with the development of a new product, we debit the research and development expense and credit cash. When Marshall lost a patent infringement suit, we would debit legal fees, expense, and credit cash. And then number 3, Cleanway bought equipment. They paid $6,000 down and signed a non-interest-bearing note requiring the payment of $18,000 in 9 months, and the cash price being $23,000. We would debit our equipment for $23,000. We would debit $1,000 for the discount on the note payable, credit our cash of $6,000, and then credit our note payable for $18,000. For number 4, we debit the building sprinkler system as an asset and credit our cash. And then when the Mayer Company paid $12,000 in legal fees with a successful infringement suit, we would debit our asset, patent, credit cash. And then last, when Johnson traded its old machine with an original cost of $7,400 and a book value of $3,000 plus cash of $8,000 for a new one that had a fair value of $10,000, we would debit the new machine for $10,000. We would debit our accumulated depreciation to zero it off the books. We'd credit our cash, credit our old machine, and then from that show a loss on the trade of the equipment. The percentage we use to amortize computer software development costs under GAAP is the greater of the ratio of current revenues to current and anticipated revenues, or the straight line percentage over the useful life of the software. This approach is allowed under IFRS, but not required. Amortization under IFRS typically occurs over the useful life of the software based on pattern of benefits, with straight line as the default. Research and development performed for others. Now, the principle requiring the immediate expensing of R&D doesn't apply to companies that perform R&D for other companies under contract. In those situations, the R&D are capitalized as inventory and carried forward into future years until the project is completed. Justification is that the benefits of these expenses are the contract revenues that will eventually be recognized. Income from these contracts can be recognized over time or at a point in time depending on the specifics of the contract. So whenever a company introduces a new product or service or begins business in a new industry or with a new customer, it incurs startup costs. As with research and development expenditures, a company must expense all the costs related to a company's startup activities in the period incurred, rather than capitalizing those costs as an asset. Startup costs also include organization costs related to organizing a new entity, such as legal fees and state filing fees to incorporate. Technological feasibility is established when the enterprise has completed all planning, designing, coding, and testing activities that are necessary to establish that the product can be produced to meet its design specifications, including the functions, the features, and technical performance requirements. cost incurred after technological feasibility, but before the software is available for general release to customers, are capitalized as an intangible asset. These costs include items such as further coding and testing and the production of product masters. Capitalized costs are then amortized over the economic life of the software. Any costs incurred after the software release date generally are expensed, but are not part of R&D. This slide shows the R&D timeline introduced earlier in the chapter, modified to include the point at which technological feasibility is established. Only the cost incurred between the technological feasibility and the software release date are capitalized. The amortization of capitalized computer software development costs begins when the product is available for general release to customers. The periodic amortization percentage is the greater of the ratio of current revenues to current and anticipated revenues, percentage of revenue method, or the straight line percentage over the useful life of the asset. Astro Corporation would expense the $1,200,000 in cost incurred prior to the establishment of technological feasibility and capitalize the $800,000 in cost incurred between technological feasibility and the product available date. 2019 revenues from the sale of the new product were $3 million, and the company anticipates an additional $7 million in revenues. The economic life of the software is estimated at 4 years. The 2019 amortization of the software development cost is determined by calculating amortization under both the percentage of revenue method and the straight line method. So the amortization of capitalized computer software development costs begins when the product is available for general release to customers. The periodic amortization percentage is the greater of the ratio of current revenues to current and anticipated revenues, which would be the percentage of revenue method, or the straight line percentage over the useful life of the asset, shown here. The periodic amortization percentage under percentage of revenue method is 30%, which is calculated by dividing the current revenues of $1 million by the sum of current and anticipated revenues of the $3 million and $7 million. The amortization is $240,000, which is 30% of the $800,000. Now, under the straight line method, the periodic amortization percentage is 25% because the economic life of the software is estimated at 4 years. The amortization is $200,000, which is 25% of the $800,000. The percentage of revenue methods used because it produces the greatest amortization of $240,000. It's not unusual for one company to buy another company in order to obtain technology that is acquired, the company has developed or is in the process of developing. Anytime a company buys another, it values the tangible and intangible assets acquired at fair value. When technology is involved, we distinguish between developed technology and in-process research and development. So to do that, we borrow a criterion used in accounting for software development costs and determine whether technological feasibility has been achieved. If it has, the value of that technology is considered developed, and we capitalize its fair value, which means we record it as an asset, and then we amortize that amount over its useful life, just like any other finite life intangible asset. For in-process research and development, which is technology that's not reached the feasibility stage, GAAP requires the capitalization of its fair value. But unlike developed technology, we view in-process R&D as an indefinite life intangible asset. So we don't amortize indefinite life intangibles, but we monitor these assets and test them for impairment when required by GAAP. If the research and development project is completed successfully, we switch to the way we account for developed technology and amortize the capitalized amount over the estimated period the product or process developed will provide benefits. If the project is abandoned, then we expense the entire balance immediately. Research and development costs incurred after the acquisition to complete the project are expensed as incurred, consistent with the treatment of usual R&D expenditures. Whenever a company introduces a new product or service or commences business in a new territory or with a new customer, it incurs startup costs. Now, some of these may be organization costs related to organizing a new entity, legal fees, state filing fees. Prior to 1999, companies frequently capitalized startup costs until the new business started and amortized organization cost over 5 years. Now, as with R&D expenditures, companies are required to expense all the costs related to a company's startup and organization activities in the period incurred rather than capitalize these costs as an asset. So let's look at another concept question. During 2018, the Ellison Software Company incurred development costs of $8 million related to a new software project. Of this amount, $1,600,000 was incurred after technological feasibility was achieved. The project was completed in the middle of the year and the product was available for release to customers on July 1st. Year 2018 revenues from the sale of the new software were $2 million, but the company anticipates future additional revenues of $18 million. The economic life of the software is estimated at 4 years. Year 2018 amortization of the software development costs should be A, $800,000, B, $200,000, C, $400,000, or D, $160,000. So as you see, using under the percentage of revenue method, we would take the $2 million, divide that by the $20 million, which gives us 10%. That times the $1,600,000 is $160,000. But using the straight line, 1/2 of the $1,600,000 divided by 4 gives us 200,000. So therefore, we're going to use the larger amount of $200,000. Let's look at exercise 1027. Delaware Company incurred the following research and development costs during 2018. So you see our salaries and wages for lab research, materials used in the R&D projects, purchase of equipment, fees paid to third parties for the R&D projects and patent filing, salaries, wages, supplies for R&D work performed for another company. The equipment has a 7-year life and will be used for a number of research projects, with depreciation being $120,000. Our job: calculate the amount of research and development expense that Delaware should report on its 2018 income statement. So as you see here, our lab research for salaries, $400,000. The materials used in the R&D projects, $200,000. The fees paid to third parties for the R&D, $320,000, and the depreciation total $1,040,000. Patent filing and the legal costs get capitalized. The salaries, wages, and supplies for the R&D performed for another company get included as inventory, and then once the job is completed, they're expensed. There are 2 generally accepted methods that companies can use to account for oil and gas exploration costs. The successful efforts method requires that exploration costs that are known not to have resulted in the full discovery of oil or gas, sometimes called dry holes, be included as expenses in the period the expenditures are made. The alternative, called the full cost method, allows costs incurred in searching for oil and gas within a large geographical area be capitalized as assets and expensed in the future as oil and gas from the successful wells are removed from that area. Both of these methods are widely used. So the accounting treatment of the $20 million in total exploration cost will vary significantly depending on the accounting method used. The summary journal entries using each of the alternative methods are shown on this slide. So using the full cost method, Shannon would capitalize the entire $20 million, which is expensed as oil from the 2 successful wells is depleted. But on the other hand, using the successful efforts method, the cost of the unsuccessful well gets expensed in 2018, and only the $4 million cost related to successful wells is capitalized and expensed in future periods as the oil is depleted. Oil and gas companies can use either the successful efforts or full cost method to account for oil and gas exploration costs. Of course, the method used must be disclosed. So let's look at our last concept question. The Jill Oil Company incurred $2 million in exploration costs for each of 10 oil wells drilled in 2018 in West Texas. 8 of the 10 wells were dry holes. Under the full cost method, Jill will debit what amount as the exploration expense? 0. If using the full cost method, Jill's going to capitalize the entire $20 million, the 2 times 10, which is expensed as oil from the 2 successful wells, is depleted. So in this case, exploration expense is going to be 0. There you have it, guys. Chapter 10 is completed.